To the markets and the sell-off as traders are bracing themselves for a prolonged conflict. In the US, excuse me, do beg your pardon, all the major indices were down, and yet they'd recovered off the lows, well off the lows of the day. As we were talking, Brent's briefly approached $85, but the markets, the dollars, they're all falling back. Gold gave back some of its gains. It was the only safe haven of the day, and the US dollar, which of course did put on a bit of ground. So that gives you an overarching view of where we are. And Jared Bernstein's with me, the former chair of the White House Council of Economic Advisors under Joe Biden, now policy fellow at the Stanford Institute of Economic Research. Jared, when I look at those numbers, away from the knee-jerk, I'm guessing what I'm seeing is the uncertainty. You can't really price in a longer war, but you've got to be cognizant of the fact that's where we could be headed.
I actually think that's the key issue right there. I mean, the one variable that in some ways is the most important and the most mysterious is duration. If this war is a 4-week affair, I think supply chains, commerce, flow through the straits, oil production, shipping, refining, all of that snaps back pretty quickly. If instead of 4 weeks, we're talking about 4 months or longer, very different discussion. So duration is key to economic impact.
When you've been in government and part of various policy making, what sort of discussions are taking place at the moment? Where does the economics fit into the if you will, the strategic decision making?
Well, to put it simply, at the gas pump. If I were in the White House right now, I'd be getting calls from everyone from the senior staff to the president saying, hey, remind me, what's that rule of thumb you're always talking about when the price of oil goes up by $10 a barrel? And that rule of thumb is 25 cents at the pump. Now, if you look at the average across the nation here, you'd see that gas price a little bit south of $3 a gallon. You know, you break that $3 measure, you go up to $3.25 because in fact, WTI is up about $10. People will notice that. And that's one of the most acute, quick kind of acting prices that we see. And by the way, it links very closely into the affordability debate, which is an area where President Trump has been doing very badly.
The Fed watches all of this. And I mean, this is the classic dilemma in the true meaning of the word. You can't cut rates to buy a bit more insurance because you're already elevated, and you dare not raise rates because you're elevated, and you've got higher inflation that might come feeding through from oil. What do you do?
Well, at least as far as Chair Powell is concerned, he'll tell you all day long that the direction of travel is toward lower rates, while he very wisely, I think, wants to sit back and look around for a while and see what their rate cuts have done thus far in the macro economy. He's consistently weighted the labor market as a greater concern because he believes that were it not for tariffs, the price indices would be heading back to target. Okay. Typically, they try to look through supply disruptions. That gets pretty tough if we're talking about the longer duration scenario I outlined before.
Jared, again, give me insight. You've sat in the room, you've heard the debates. What happens when it gets to the stage, on the one hand, on the other hand, but on the other hand, but on the third hand, but then we could do this. What happens when it becomes so complicated that you really can't game it out?
Right. Now, that's a great question. There's one of our earlier presidents said in such a situation, bring me a one-handed economist for precisely the reason you mentioned. Look, by the time you get to the president and the folks who are making the decisions, you've hashed that out with your team. So we don't do a lot of that in front of the president. What we would instead do is say, sir, here are three scenarios, sort of good, bad, and middle. And in this case, what they would be probably, at least in my lane, would be, here's what happens if oil stays up for a while. Here's what happens if it just comes right back down to where it was. And here's the middle path.
Finally, is it your view that fundamentally the US economy is in good order, and this is quite a risk that the president, I mean, we won't get into his reasons one way or the other, but he's taking quite a risk with an economy that's not doing badly?
Richard, that is precisely my view. And it's a strongly held view of mine that this economy has been good, has been solid, whether you're talking about GDP, productivity growth, an unemployment rate that at 4.3% is relatively low, stock market that has before this been doing pretty well, certainly some very nice investment numbers, but you can only throw so much at that resilience before it breaks. There are real fragilities in our economy. In our labor market, we have a very low hire situation, so there's not a lot of margin there if layoffs were to pick up. On the investment front, I think AI looks kind of bubbly. And then on the uncertainty front,
right,
a lot of businesses were already nervous about that outlook. So I'm worried that this is perhaps a nudge too far against the underlying resiliency of the U.S. economy.
I'm glad you're with us tonight, Jared. Thank you so much. We'll talk more as this